We're on for another episode of the GraphRag Curator podcast, and I'm Alan Morrison, and I'm very pleased to have Cheryl Dunn with us. And Cheryl is an accounting professor at Grand Valley State. She's on an absence of leave right now because she's working for Semantic Arts as a budding ontologist. And Cheryl, welcome. Tell us about this journey you've taken, because you've got this book called The Future of Accounting we want to talk about. And there's all the, it's unusual, let's say, for a CPA and an accounting professor to take on becoming an ontologist and actually getting down in the weeds with ontology. So I'm curious about what you're thinking and where you've been over the past few years.
Well, thank you, Alan. I'm delighted to be here, and thank you for inviting me to be part of this. Yes, the new book is The Future of Accounting, and my roots started when I became a student at Michigan State University many, many years ago. I was fortunate enough to learn from a man named Bill McCarthy, who was my professor for my first accounting information systems course there. And I wasn't sure whether I wanted to major in accounting or computer science when I was young. And then when I did my green carpet tour at Michigan State, they told me, oh, we've got the perfect fit for you. We have a major in accounting information systems that kind of combines accounting and computer science. And so I did that, and I happened to take Bill McCarthy for the AIS, the first AIS class, and he taught a model called Resources Events Agents. And it basically taught relational database theory with accounting, and said that if we can account for all of the events in a company, along with the resources that are involved in those events and the agents that participate in those events, we can capture all the information that that company needs, not only to do the accounting that they need, but also for their management, their marketing, and other information needs that they have. And so he was basically thinking about the foundations for ERP before ERP was even ever invented. And he wrote the landmark paper for REA in 1982 was when it was published. So he actually worked on it earlier than that. He actually worked on that as part of his dissertation at UMass many, many years ago. And so I started teaching. Well, when I went into public accounting, I worked for Coopers & Lybrand back in 1988 and 1989. So I'll go ahead and date myself. And after having gotten my bachelor's and master's degree in accounting at Michigan State, it was a combined program. So I got them both at the same time. And it had a specialization in accounting information systems. And so along with that first AIS class, I then had several more accounting information systems classes, along with some computer science classes. And I had learned to do a lot of things with spreadsheets and relational database technology and a little bit of AI. Back then we had ExpertSys was one of the expert systems software programs we worked with a little bit, very rule driven. And when I got to work for Coopers & Lybrand, the first day they said, well, did you buy your 10-key adding machine yet? I said, really? We're not using computers to do this work? And they said, well, there's like 5 suitcase computers in a closet, but nobody ever uses them. Sometime if you want to take one of those out to one of the clients, maybe you can. You'll have to get your in-charge's permission to do that. But we pretty much do everything manually. And so I started my work as an auditor using this, 22-column green ledger paper and writing everything out by hand and making red tick marks when we re-added up something that was generated by a computer, because you never could trust numbers that came out of the computers even back then. And so finally,
what year was this when you started?
This was 1988 and 1989.
Okay.
So it was a while back.
Yeah, I mean, it was still pretty much the standalone PC era still.
Yes.
I mean,
yes.
They had LANs and such, but not a lot. Certainly the internet was on down the road a bit.
Yes, definitely. We had, there were PCs. I actually did buy a Zenith PC when I was in my master's program, and I was so proud of that machine. It had an 8088 processor in
Yeah.
it, and it had a 20 megabyte hard drive.
Yeah.
And a lot of them only had dual floppy disks drives at the time. And so the fact that I
Wow.
had a hard drive was pretty cool. And so at any rate, the computers that we had, they were suitcase computers, you know, they weighed about 50 pounds. And I had to really struggle just to put one up on the table to take it with me to go someplace. But it was a computer, and that was pretty cool, you know, whereas a lot of the computers up till then had been room size, and you couldn't take them anywhere. So the fact that these were portable was really amazing. And so finally, I was really tired of doing all of this adding up with an adding machine and all this stuff. And I had to do a fluctuation analysis for a client where you take this year's numbers and last year's numbers, and you subtract this year from last year, and then divide the change by last year's number to see what percentage it changed by. And we had to write out all of the accounts that were, all the line items on the balance sheet and on the income statement, and then make those calculations. And then any that were over a certain percentage, we had to find out why the change was so big. So we had to go interview the client and find that out. And I looked at that and I said, that's the perfect application for a spreadsheet to do instead of me doing that manually. And so I had gotten comfortable enough with the in charge on that job that I said, you know, please, can I take one of those computers out and do this fluctuation analysis on a spreadsheet instead of doing it by hand? She's like, what's a spreadsheet? And so I explained what a spreadsheet was. Back then it was actually Lotus 123. It wasn't even Excel. But it had the same functionality, you know, certainly capable of storing formulas. And then, so I told her, I said, you know, I'll type in all the same information, and then I'll make formulas for the changes and for the percentage. And then next year, all somebody will have to do is move this year into last year's column and then type the new numbers into the this year's column. It will automatically recalculate all of the dollar value changes and all the percentage changes. And so then all they'll have to do is go find the answers from the client for the ones that changed by more than whatever percentage. And she said, well, that's going to take you way too long, and nobody's going to know how to use it if you're not here next year. And so I really don't think that's a good idea. And I said, okay, it won't take me longer. It will take me less time than writing all that stuff out by hand and doing the calculations on an adding machine. I said, but if it will make you feel better, I said, I will, in the same amount of time, I will do that work, and I will write a manual for how to use it for whoever does this next year with step-by-step instructions. I will personally train you on how to do it so that you'll know how to do it next year, no matter what else happens. And worst case, I'll print out the fluctuation analysis and paste it into the green ledger paper, and I'll still make the same red tick marks. I'll re-add up everything on the adding machine just to, you know, prove my numbers. And then it will be as if I did it by hand to begin with, as far as what somebody sees next year, if they don't want to do it on a spreadsheet. And so she said, well, if it takes you longer, you're going to have to eat the hours. I said, not a problem. I'm happy. And so I did it, and then I showed it to her, and I showed her how, you know, you would be able to change it next year. I gave her some hypothetical numbers. Okay, what if next year was this? All you'd have to do is this, and showed her how it worked, and her jaw just dropped. And that's when I realized, oh, a lot of people don't know how to do this stuff that I learned at Michigan State. And so I need to go get a PhD and teach other accounting majors how to do this stuff, because this is, you know, where accounting needs to go from here. And at that time, academia, in my opinion, was ahead of practice. At least Michigan State was ahead of Coopers and Lybrand's Knoxville, Tennessee office. And you know, I can't really speak to other offices and other universities. I can say that when I looked for PhD programs that also had accounting information systems emphases, there weren't any. So I had to go back to Michigan State because I just couldn't find any that had what I was looking for. And I knew I had to learn more from Bill McCarthy. And so that's why I ended up going back to the same university for my PhD, even though I knew it wasn't really the best idea to get 3 degrees from the same school, especially if I ever had any interest in teaching at that school, because I kind of made it so they would never hire me. And so at any rate, I did go back there for my PhD, and I studied with Bill McCarthy. He was my dissertation chairman. I learned a lot more about REA and helped him with, developing it further, and also learned how to do, behavioral research experiments and that kind of thing. And so since he and his and a couple of his other previous doctoral students were very focused on what we call design science research, where they were, how to build a better mousetrap and how to build a better accounting system in this case, I decided to specialize in the behavioral research area and test the parts of the model to see how people interacted with it, because that was a gap that was there. And so I and a couple other colleagues have been testing REA in various ways throughout the years. And we called REA a semantic model of accounting phenomenon. We used to have a workshop every year that we called the SMAP workshop. And so then when I started hearing about semantic technologies, I got intrigued because it seemed consistent with REA. And so I wanted to find out if it really was. And there was a year where I had a very generous dean that allowed me to go to a semantic technology conference that was more expensive than most of the academic conferences we went to. But he said, sure, that sounds like a great idea for you to go to a practitioner conference and see what's going on there. And at that conference, I happened to meet Dave McComb from Semantic Arts. And I sat in on one of his sessions where he introduced GIST, the upper level ontology that Semantic Arts uses. And I was amazed at how much overlap it looked like there was between GIST and REA accounting. And so that made me want to hear more. And so he had a second session in that same conference, and I went to that one too. And he recognized me as having been at his previous one, and we talked a little bit. And then I ran into him in the airport after the conference and got to talk with him a little bit more and told him a little bit more about REA and what I'd been doing with that. And I asked him, I said, I can't conceive of a company needing more than about 300 to 400 relational database tables to do most of what they need to run their company. Certainly to get all their accounting information, but also to get, a lot of the other information they need for HR, production, scheduling, marketing, all that other stuff. And he kind of looked up and he said, yeah, that's about right. And I said, okay, so I don't understand then, why do these big ERP software packages like SAP and PeopleSoft have 12,000 tables or 20,000 tables? And he said, well, because they make copies of everything. And it was kind of like a light bulb went off, and I went, okay, relational is not the way to go. If we have to copy everything to make the system work, then these semantic technologies really are what needs to be done. And so I came back from that conference and, thought I had, found this brilliant thing. And of course, then life got in the way and I didn't use it for a while. I became the department chair at Grand Valley is what happened. And so my life got taken over with administrative work. And so then it was a few more years before I got back to the idea. And I happened to go to the 2019 Designing and Building Business Ontologies, DBBO, was a workshop that Semantic Arts used to put on. It was like a week-long thing.
Yeah, I did that back in 2015, as a matter of fact.
Okay, wonderful.
Yeah.
Well, so I did it in 2019, and it was fascinating. I was just, learned so much and said, okay, I can see where we could do this with REA and just implement it in this way instead of implementing it with relational databases. The theory still holds. The idea of capturing the events and then relating the resources and agents to them. And we have different kinds of events in REA. We've got economic events, we've got commitment events, we've got instigation events. and then trying to connect those to each other as well as connecting them to the resources and agents. It really is sort of like, kind of like a knowledge graph, only we're not capturing the data in the knowledge graph the way semantic technologies do. And so then again, I went back from the conference and said, okay, now I've got these tools I can use. I learned how to use Protege and how to build Sparkle queries, but only brushing the surface. And then again, the department chair job got in the way, and I got caught up with the academic stuff, and said, okay, that's the theory stuff is going to have to wait. And but then I had the chance to apply for a sabbatical, and I thought, oh, if I'm going to do a sabbatical and take a whole semester off from teaching and administrative work, maybe I could go work for Semantic Arts for that time. And so I contacted Dave and said, hey, could I come be an ontologist for a semester and learn how to do this better? Because if I'm actually applying it every day, I won't forget how to use it. Whereas when I just go for a week-long conference and then come back and don't use it, I forget. And he said, well, yeah, I think we can arrange that. And so I put in my application, my sabbatical was approved, and then COVID hit. And so then all the sabbaticals got postponed by a year because the budgets all got cut with COVID and had to redirect money to PPE and stuff like that. So I told Dave, I was like, okay, it's going to be another year down the road. And he said, oh, well, that's too bad. He said, well, maybe we should write a book. And instead of you working for us, maybe we should write a book, and we could, start at any time. And so very slowly but surely, we started working on data-centric accounting. And data-centric accounting is a little bit different from REA accounting. It doesn't have some of the concepts that REA includes. Most particularly a notion called duality that connects the economic increment events to the economic decrement events. So it specifically connects, for example, a cash receipt to the sale that cash receipt applied to. And we're not saying that connection doesn't belong there, but it's not always easy to implement. And we realized that really what we need to do is connect at a little bit earlier stage. And so our data-centric accounting is all centering on the commitments. And so we're saying, okay, if you've got a commitment that is, for example, a sale order, now you're going to connect that sale order generates two things. One is an obligation to do something, and one is a right to receive something. And so if you are making a sale, for example, if it's a sale order, then once that commitment is made, once it's agreed on by both parties, now you've got an obligation to deliver the goods or services that were ordered by your customer, and you have the right to receive payment from your customer. Those things could happen in either order. We don't know which one is going to happen first. Well, we know based on the commitment which one is supposed to happen first. But before the commitment was made and agreed to, it could end up happening either direction. And that bidirectionality is the tricky part of duality when it comes to implementing it in semantic technologies, because those graphs are directional.
Yeah.
But we do know that they're generated from the commitment. And so if we can tie them back to the commitment, we've got the directionality handled without any issues. And so we keep track of the obligations and the rights that those commitments generate, and then we keep track of the fulfillments of those obligations and rights. And once everything is fulfilled, now the transaction is complete.
That's some really good background, and I wanted to just let our audience know that you and I know Dave, but perhaps other people don't know Dave. And there's this whole philosophy of data centricity that Dave has written about, you and he have written about. And so I'm wondering, we've got the data centric principles, and Dave wrote a book called Software Wasteland that talked about all the complexity and all the fragmentation and siloing that goes on inside systems. It's just a nightmare. If you read that book, it's just astounding how much waste there is in how software is done. So Dave has a philosophy that comes from his consulting background, where he did implementations and he understood where the waste is when it comes to custom software projects, for example. How does that relate to this book? Because it's a follow-on in a series of books that talks about data centricity.
Yes, absolutely. And the idea with data centricity is that we don't want to be application centric. In the software wasteland, he talks a lot about application centricity, and that's what resulted in the need to copy all those tables in the other systems, is because every time they made a new application, they basically made a copy of the database or the parts of the database they needed to use, and it exploded into all these different tables that ended up being an integration nightmare.
Yeah, and there was a whole standards effort in Canada that's called zero copy integration, which is, the people who are in the data warehousing environment, they're so frustrated at all this duplication and want to get rid of all the copies, and so they developed a standard in Canada. Dan Demers did, called zero copy integration, so that you wouldn't be copying all these times. But I mean, it's sort of like the software industry has just got so much momentum, it's hard to even gain a foothold if you're trying to remove the copying aspect of it.
Yeah, you're absolutely correct. And actually, one of the sessions that Dave gave at a conference a couple years ago was called Zero Copy Integration. And and he was talking about how if you make a data-centric architecture for your firm, you're basically making one data model for the entire firm, and you're going to use that model for everything. You're not going to have to make copies of it, because your data is all going to be there. There's going to be a single source of truth, and then you're going to pull that single source of truth information for whatever you need it for, and any manipulations you need to do can be done at the interface level, not at the data level. And that's also REA's goal. REA always has had that goal of being interoperable, being able to connect this system with that system without having to make copies of anything, but just to be able to say, okay, if you've made your model for the revenue process and you make a model for the acquisition process, you find where they have classes in common and you link them together based on that. And the interoperability is much cleaner and easier with semantic technology than it is with relational database technology, because trying to connect those tables together after the fact can be tricky. Whereas if you've got a knowledge graph, then it's just a matter of saying, oh, these nodes are the same thing, now connect them. And so that's what we're trying to do with data-centric accounting, is say, okay, if we can keep track of all of those business process events, and we also see that there's a pattern across all the events. So there's three main types of processes that all companies have: a buy process, a sell process, and a make process. So we buy something, we sell something, and we make something. And the make something doesn't always mean that you're manufacturing a product. The make process might be you're selling consulting services. And so you're performing a service that is creating value for the customer. You also could have make processes within your company that are internal for things like maintenance of equipment and things like that. So those kind of processes follow this same kind of pattern. And again, with all of those patterns, we have those components. There's some kind of a commitment that gets made, whether it's a mutual commitment between an external party and ourselves, or whether it's between two departments within ourselves. There's going to be a commitment where we're agreeing to get something and we're agreeing to give something up. And once we have that agreement stored with all the pieces that it needs, the resources, the agents, anything else that needs to be connected, then we keep track of the rights and the obligations that are generated by that commitment. And then we keep track of the fulfillment of those. And at each of the different stages along that process is going to result in different accounting implications. And so really this is a business issue, not an accounting issue, right? We're building business systems that can generate the accounting, but we're not starting from accounting and messing things up for the rest of the business, which I think is what a lot of the other systems do when if it's a general ledger focused system, that what's happening is you're contaminating the data with all of the assumptions that you make for accrual accounting when you put the data into the system. And then that data is unusable for a lot of other purposes across the company. And so that's why they have to have other systems that keep track of the information themselves, because they need it in a different format than the accounting system needed it for.
Yeah, and so just wanted to interject here because there's this whole upstream aspect of the business side of things that needs to be sort of intact and do things the way it does. And then the accounting picture can come into play with the adjustments and the accruals, et cetera, if you need to do them. But it just seems like it's so much more straightforward to begin with to capture that elemental approach with the events and the resources and the agents. And just talking about agents, obviously we think about how the number of identities in a system is going to explode because of all the agents that are coming online. And you're going to have agents who will need access to certain of this information. They will need to generate some of this information, and all of it has to be provenanced and auditable. And we need to set that up upstream with the business units so that it's a trustworthy system.
Yeah. So Dave has a great
and so this accounting really ties back to all of that motivation, doesn't it?
Yeah, it really does. Dave has a great analogy where he'll say, imagine that all of your business events are like raindrops and they're falling down. And in today's systems, we either let them go ahead and fall to the ground and then they get fed into pipes that go to the different systems, or you could think of it as we're catching them in buckets. And so you've got one bucket that's called accounts payable, and you've got another bucket that's called production, and you've got another bucket that's called marketing. And we're capturing the raindrops in these different buckets, and they get all mixed together. Once they hit the bucket, they're just water, and you can't distinguish one raindrop from another.
Right.
And then we take these buckets from these different areas and we pour them into this giant bucket called general ledger. And there again, you can't differentiate what were the initial transactions that all got lumped together into here. So that provenance is not exact. You know it came from this other bucket, but you don't know the intricate details of each event. But he says, imagine if you could freeze each raindrop. Imagine if you could freeze that raindrop and, okay, now it can fall into that bucket, but then you can tag that raindrop with the details of that individual transaction. And then you can take all those frozen raindrops and you can connect them together with that graph. And it's just a very different way of looking at it. And now all of a sudden you've got full provenance. You've got a complete audit trail from the initial transaction to the financial statement number that ended up being a part of. And accounting ends up being basically a byproduct of the business rather than something that's trying to drive the business. And that's the way it should be. The people that are in the business events that are making the decisions and making those commitments, they're the ones that are most qualified to say why they did it. And they're the ones to say, oh, yeah, my intention with buying that chocolate was to manufacture chocolate chip cookies. So it was a raw material ingredient. Or I bought that chocolate to give to customers at the end of the chocolate factory tour. And so, no, that's not raw materials inventory. That is a supply, basically, that's being used as part of the marketing of our company. And how you account for that matters. in the financial statements, and having accountants be the ones to make that decision of how to classify that doesn't make any sense, because they're way after the fact, whereas the people engaged in that event, they actually know why they did it, and they're the best ones to classify.
So this is data aware and knowledge aware accounting.
Yes.
And you've got people are using this term context graphs.
Yes.
Ever since a VC firm came up with their concept of a concept graph and blogged about it in December last year, there's this term that has started to gain a lot of momentum called context graphs. And what you were saying, Dave, was talking about with the raindrops is collecting those raindrops according to context. But there's an original context that you want to preserve. And then there's the accounting context that goes with accounts payable, for example. So you need to attach these various contexts to the data with the tagging in a way. Is that something you're working on as an ontologist at Semantic Arts?
So not on any client engagements yet. We're hoping that we'll get some data-centric accounting clients before too long, but we are implementing it at Semantic Arts as a proof of concept. And so Dave says that for most any firm, if you take the number of employees that they have and you divide by 10, there's about one application for every 10 users. And then he realized that at Semantic Arts, it was worse than that. And so at Semantic Arts has about 30 employees, and they had about, I don't remember how many he said, 15 systems. You know, when you look at the QuickBooks for accounting and the Pipedrive for their sales tracking and time management, and I don't remember what all the different systems were, but as he and I were talking, he realized, you know, we should be eating our own dog food, and we should make our system data centric. And so they've been working on that for several years now, trying to get all the pieces in place to replace all those different systems with just one data centric architecture. And when it got to the QuickBooks piece of it, that's where it became really difficult to try to transition that over, because the detail was lost, right?
Yeah.
Raindrops weren't frozen. And so now trying to take that old data and put it into the data-centric format has been a little bit challenging. But we're working on it and realizing that, okay, we can only get it to a certain point, and then we'll have to just go forward with what we can get going forward. You know, we can't reinvent the past, and so we're just going to not have some of what we need for the past. It would be great if we could do this for a brand new company that had a clean sheet that we could just start from scratch. It would be much easier than trying to change an existing firm's system. But we're working on some ways to do it. We're finding ways to make it happen. And once we get that all completely done, we're working on an implementation guidebook to go along with this. This book is mostly the concepts and theories. And then we're working on an implementation guidebook to give people more detail about how do you actually make this happen. And we realized that we needed to break it into 3 phases. So we actually have 3 phases of data-centric accounting. And in the first phase, we're not getting rid of all of the accounting artifacts that we think we need to get rid of. We'll keep the concepts of accounts. You might think it's kind of odd that we're talking about getting rid of the concepts of accounts for many of the transactions that a company has. And I'll say we aren't getting rid of all accounts. We're just getting rid of the temporary accounts that are used in accounting, because we're getting rid of the idea of periodicity. Now, for those of you who aren't accounting people, the concept of periodicity means that we have to specify ahead of time what time periods we're going to want accounting information reported for, because there are some kinds of activities that we can only store up for a period of time, and then we have to move them somewhere else. So for example, a sales account. A sales account is going to have to start empty on January 1st. so that when we put more stuff into that account through January 31st, if we want a month's worth of sales transactions, we had to have gotten rid of all the other sales that might have been put in there in previous periods. Then at the end of January, we'll empty it out again so that it can start February with a clean slate. And those are the accounts we call temporary accounts. And when those get transferred, they get transferred to an account called retained earnings. And so anything that would increase earnings, like sales, will become a positive to retained earnings. And then expense accounts that would decrease retained earnings are going to get transferred to retained earnings as negatives. And so that the difference ends up being your earnings getting accumulated in that retained earnings account. Well, those temporary accounts, what if you don't want sales for that month of January? What if you want sales for last week? What if you want sales for January 1st through January 17th? In a traditional system, you can't get that, or at least it's not easy to get that. Whereas in a data-centric environment, if we're just tagging all the transactions with their dates, with their amounts, with what resources were involved and who was involved and that kind of thing, we can reassemble them any way we want to. And so we don't need that concept of periodicity. And so instead of having sales accounts, we're just going to have all those raindrops that are frozen that have the sales tag on them. And it's not a sales account per se. The account is only there at the reporting level, not at the storage level. And there will be some accounts still. So there will be what we call counterparty accounts. And so your customers, your vendors, you're going to have accounts with them the same way you might have a frequent flyer account with your airline. And so they're keeping track of the points balance that you have of your airline miles. So we'll still have something like that. And that's where we will be able to manifest things like accounts payable and accounts receivable. And in Data-Centric 1, we're not even taking away all of the accounts. We're not taking away the sales accounts and things like that because it's too hard to transition from a company that's been operating under a general ledger system for the last 30 years. Okay, now we've got to phase them in. And so we'll phase them in gradually so that in phase 1, they still keep their accounts, but now we're capturing a lot more detail so that then when they're ready, then we can transition to phase 2, where now we've got the detail, we've got the frozen raindrops. Now we can start putting it together in a much more robust format. And then phase 3 would be moving to a blockchain kind of architecture where we're not just looking at systems from an enterprise-centric viewpoint, but we're looking at them from what we call an independent or a helicopter view, where, okay, now we've got a transaction and you were the seller and I was the buyer. It's captured at an independent level. And instead of being called a sale or instead of being called a purchase, it's called an exchange of goods or services for cash. And then we say, okay, in this case, you were the seller, Cheryl was the buyer, and then all the details are captured at that independent level. And I think that's analogous to what some of the European governments are trying to accomplish. I was talking with Anita Patel a few weeks ago, and she's involved in trying to make auditable systems, and she's involved with the UN CFACT project. And she said that one of, and I'm sorry, I don't remember which government this was, but they were requiring that when a company makes a sale, they have to post it on this public exchange so that the taxing authorities can get better information. And if they make it good enough, then the taxing authorities can look at these independent transactions and say, oh, yeah, that person should owe this much and that company should owe that much in taxes. And it's kind of an interesting concept. It's not fully developed, I don't think, and it can't be for a long time. But if we can get to the data-centric 3, phase 3, we could enable that kind of detail. Now, a lot of companies aren't going to want that level of detail because they're not going to want the taxing authorities to see all the pieces. But in theory, it could be done.
Well, yeah, there's a lot of explicitness from a regulatory perspective that can be achieved all of a sudden. And, since you're starting from first principles with this approach, it can be real-time reporting that goes on. I mean, this could have massive changes in terms of public company accounting and financial reports, for example. And you started the discussion with software, and it's sort of like we're revisiting what an application is. And applications are getting in the way so much that you sort of have to dispense with that whole philosophy of software and go back to something that is very fundamental, like your Professor McCarthy came up with.
Yes.
So it's just sort of astounding. And what's frustrating to me, just as a market analyst type who watches what happens and wrote about emerging tech at PwC for 20 years, I'm so frustrated with where things are in terms of the whole software environment and all of the fragmentation that you have to deal with. Everybody in the company is using at least 12 different applications, probably a lot more, and they're just jumping from application to application to get their work done. And there's no visibility across the systems. And so, that's frustrating. And we have this opportunity with agentic AI where the agents can come into play. That suggests a totally different paradigm from an agent perspective. It seems like things could be fluid in an agentic environment so that you can make these changes like the ones you're making at Semantic Arts.
Yes, it's true. Although the agents are only as good as the structure of the data.
Mm-hmm.
And so if the data isn't structured well enough, the agents can't make sense of it. And so there's ambiguity there. And as Dave says, ambiguity is AI's kryptonite. And so we've got to make sure that the data is structured correctly so that there's no question about what the data represents. Then the agents will be able to use it for agentic AI, and everything will
it's an argument for your accounting method.
Yes.
It's an argument for the architecture that is implied by standards-based knowledge graphs.
Yes.
And it's an argument to rewrite the application software so that it's out of the way of this whole functioning of the graph-based system. And I'm sure there's going to be a lot of people who don't want to go that far. There's a lot of incumbents who want to protect what they have, and they want to keep receiving subscription fees for what they have. It's hard to think about how to get started with this, but you've been talking to people in the EU, for example, or in the UN about these things. Who else is curious about this approach and thinks they could benefit from it?
So the SEC is really curious about this as well. I have talked to a couple different people involved with the SEC, and they're aware that this is that we're writing, that we had written this book, or they were aware that we were writing the book, and were very interested because I think that they realize how much better transparency could be possible for financial reporting. We don't expect the SEC to mandate data-centric accounting anytime soon, because there's going to be a lot of people that will fight against this. We expect that this will probably be adopted first by privately held companies that are large enough to need data-centric systems. Companies that QuickBooks just isn't enough for, that could really benefit from the interoperability that we could give them with a data-centric accounting system. And it won't be until the publicly traded companies see how much better the privately held companies can do with this kind of system before they'll be starting to say, okay, maybe we can give up some of the ambiguity that we like to build into our systems to hide things. There's a concept called earnings management that is done by most publicly held companies to some extent. Most of them don't do it to such an egregious extent that we would say they're committing fraud. Some do, and they tend to get caught. And then we have blow-ups like with Enron and WorldCom and that kind of thing. But most of them do it at least to some extent because they're under such pressure from analysts who are predicting that their price per share is going to do this when they make their earnings announcement. Then they kind of feel pressure. Oh, we've got to make that. So we've got to keep our earnings looking positive enough that, we're not going to fail to meet that expectation that the market has right now. And so, okay, well, a lot of our numbers in accounting are estimates, things like depreciation, things like amortization, things like the allowance for bad debts. And so, let's just, see if we can justify making our depreciation be this, and this other estimate be that, so that we can make our earnings target. With data-centric accounting, you're not going to be able to do that because everything's going to be exactly traceable. And we'll take those long-term transactions, such as the purchasing of fixed assets, and instead of depreciating them on a yearly basis, we're going to depreciate them on a daily basis. And if you have a prepaid insurance policy or something like that, as soon as the commitment is made, we're going to say, okay, that policy is going to go from this date to that date, and the amount is this, and we'll most likely distribute something like that evenly. For something like depreciation, we can see if there's a justification for doing larger amounts in the early part of the asset life and smaller amounts in the later part of the asset's life. But we're going to make that determination ahead of time. At the time of commitment, what is going to be the amount that's going to be allocated to each day in the life of that event. And so there's not going to be room for as much fudging as there has been in the past. And I think that's going to be scary to some, and they're going to resist this. But I think it's got tremendous benefit for society if we can make it happen.
You mentioned the blockchain approach and how the third phase is in some way related to the blockchain approach. And when I think about blockchain, I think about transactions that can happen and an immutable data store. So you have kind of a log file kind of approach to storing the transactions. And so you have this immutability, I'm assuming, in the third phase, where you've got this historical record. So for auditing purposes, that just seems like a really essential thing to have, is you've got this snapshot on time of every transaction. And, if there are variations or changes, then those are logged separately. Is that what you're referring to with the phase 3?
Yeah, that's part of it. Yes.
Okay.
And I think it will really make continuous audit much more feasible. There's been a number of academic researchers, especially out of Rutgers University, that have been trying to develop and perfect the idea of continuous audit, so that instead of waiting until a month after a company's year end and coming in and taking 3 months to do the audit, so that now it's 4 months after the year end before we actually have audited financial statements. They're saying, let's go in and audit throughout the year, and then when the year end comes, you don't have to do any more audit. You've already got it all audited up to that point. And so it can make companies' records available a lot sooner. And this kind of a system is something that can facilitate that a lot. So I'm looking forward to seeing what can happen with our communities working together with data-centric accounting and continuous audit.
Yeah. So you're probably seeing accounting systems in the semantic arts environment in a totally different way with this
Yes.
approach. Can you talk a little bit about, your day-to-day, Dave mentioned eating the dog food, having, basically semantic arts wants to understand how to do this for itself first. And that's a proof point. So you've got this proof of concept. Can you talk about what it's like to work in a system like this? How's it different?
So the developers are doing most of the work with their actual data. I've been mostly just advising them on when they have questions about accounting policies. But the idea is that we're going for, when we take the data, we need a piece of information that we call intention, and we need a piece of information that we call policy. And once you have the intention and the policy, then you can put that together with the data to determine how it gets accounted for. And so the intention is, should it be raw materials inventory? Should it be the supplies at the end of the chocolate tour? And then the policy is which set of standards do you want to apply to it? And so in a traditional accounting environment, you have to make a decision up front. Are you going to use cash basis accounting, or are you going to use accrual accounting? And cash basis accounting will only account for revenues when the cash is actually received. So if you sell something to me, but you give me till next Tuesday to pay you for it, then you don't record the revenue until next Tuesday when I actually pay you for what you sold me, even though you gave it to me today. In accrual-based accounting, you account for the revenue when you have done the majority of your work to earn that revenue. And so you would record the revenue today if you shipped me the goods today. And then when I pay you next Tuesday, you would not record additional revenue. You would just say, okay, now I got that account receivable received. So when you recorded the sale, you would have increased your accounts receivable and increased your revenue and done nothing with cash. And then when I pay you, you decrease the receivable and you increase the cash. Whereas with cash basis, you would do nothing until I give you the cash, and then you would increase the revenue and increase the cash. So they both end up at the same place, but because of timing differences for accounting periods, you end up with different results. So that revenue is recognized potentially in a different month, or even a different year if the transaction, spanned the December-January border, or whatever your fiscal year end is. With data-centric accounting, you can apply either policy. And so because the raindrops are frozen and tagged with when each piece of it happened, you can say, okay, show me my financial statements as if I'm using a cash basis. Or you can say, okay, show me my financial statements as if I'm using an accrual basis. Show me them using generally accepted accounting principles as prescribed in the United States. Or show me my financial statements as if I'm preparing them with International Financial Reporting Standards, IFRS. And so it's a very different kind of system from that perspective too. And so, yeah, it's really exciting to see what all is going to happen once we can get this all figured out.
Absolutely. And it just seems like it's a very expansive view that allows so much to be able to happen in a more efficient way. You're going back to the first principles, and you're making it possible to do all these things and to have this visibility step by step. So it just seems like, you mentioned fraud. I mean, the whole visibility into potential fraud becomes, I mean, it's a preventative measure as much as anything to prevent a lot of fraud. And you've got, so all of a sudden people who are in the fraud detection business, they're not so overwhelmed with their work because there's not as much to deal with. They can focus on just detecting, the stuff that does get that is problematic. So you're curing a lot of problems at the get-go, so you don't have to worry about them on down the road.
Yes.
And so it's just oodles of visibility that you didn't have before, or you had to work to really create that visibility and then sort of guesstimate that visibility.
Yes, exactly. And so we're trying to make everything much more transparent, much more visible, and it should cut down on a lot of the fraud. There are always bad actors that will find ways around everything. They'll still find ways to do bad things and commit fraud in some senses. We'll still have to have a lot of internal controls on the system to make sure that people aren't putting things in there that they shouldn't be putting in there. But it's going to take us a long way from where we are now towards preventing the fraud.
So let's say that we fast forward to May 2027. What are you doing over the next year? What kinds of things are you planning?
Well, we are trying to find some companies that want to implement data-centric accounting. So if any of you listening are interested, contact Semantic Arts. We're hoping that implementing it at Semantic Arts is giving us a lot of good lessons, but we'll learn more when we start doing it for other clients that have other business models and things like that. We are also working on the theory parts of it, along with trying to work on the implementation, just to see if there's any little tweaks we can make to improve it, because there's always room for improvement with anything new. And so, yeah, it's been exciting. We're making presentations about the book, not just this podcast. We presented at the Knowledge Graph Conference a couple weeks ago in New York, and we're open to additional presentations at conferences or workshops or to individual companies to talk more about this, and just trying to really get practice and academia both to change the way accounting is done. I mentioned earlier that I went back to school because I felt like academia was ahead of practice. Now I went from academia to practice because I think practice is ahead of academia. But I also think that the change in accounting isn't going to come from within accounting. I think the change from accounting is going to come from data scientists and software engineers that say, oh, yeah, accounting isn't just some foreign substance that we can't chew up and swallow. Accounting is just a byproduct of business, and we know how to build business systems. And if we can generate the accounting information from the business systems, we can do that, and we can make it much more efficient, much more effective, much more fraud proof. And I think that's really where the change is going to come. And so that's why I'm out here now working in an ontology position for a software consulting firm, because I think that's where I can try to make a difference in how accounting is done. And if I make enough of a difference, then maybe I don't go back to academia. But if I need to, my job is still there through August 2027. I'll have to decide before that. Whether I'm
for sure.
Trying.
Before we go, did you get any feedback from the Knowledge Graph Conference? What were people saying about your talk? Did they come up after you talked, or?
We had a lot of questions at the end of it. People were very engaged throughout the presentation, and I had pictures of the frozen raindrops and all connected together like it was a graph. And a couple of people in the audience that I knew were a former PwC partner and an IT audit manager from a different accounting firm. They turned to each other and they just went mind blown. And so the feedback we got was very positive, and people seem interested in this and very engaged. So I'm looking forward to what the next year brings.
Well, good luck to you, Cheryl, and just wish you the best. And the book is The Future of Accounting.
Yes.
And it's just been great to talk with Cheryl Dunn, and her co-author is Dave McComb of Semantic Arts. And y'all are at semanticarts.com, and I see you on LinkedIn sometimes, so people can reach out to you there. Any other places you want to mention before we sign off?
No, those are the best places.
Yeah.
Semanticarts.com, and my email is cheryl.dunn@semanticarts.com. So then it's just a trick of spelling Cheryl correctly. A lot of people don't know how to spell Cheryl. It's CHERYL .dunn@semanticarts.com, and Dave McComb is dave.mccomb@semanticarts.com, and we're both on LinkedIn, so you can find either one of us there. And reach out if you have any interest in this. We love to talk to people about data-centric accounting.
Absolutely. And the folks that are really enthusiastic, this is a place where the future is being created. So good luck to you with that. And for now, we'll sign off. Thank you very much.
Thank you, Alan. I appreciate it.